Welcome to the Snowbirds Expat Radio Podcast, powered by the Snowbird U.S. Day Tracker app. I'm your host, Gerry Scott, and my goal is to give you answers to your cross-border questions, to ease the stress of a cross-border move or extended trip, and to keep you up to date on all you need to know with cross-border rules and regulations. Now let's get on with the show. Well, hello everybody. It's Gerry Scott from the Snowbirds U.S. Day Tracker podcast. Sorry, it's called the Canada Expat Radio Podcast. I get that right every time. But anyhow, today we have Alessandro Setola, and he's from Guelph, Ontario. So once again, before we go on air, we always talk about the Maple Leafs, and everybody's excited because your big gun, Austin Matthews, is not playing tonight, so you might have a chance. So good for you guys. But Alessandro, tell us more about your responsibilities with Baker Tilly. And then we'll jump right into some very, very interesting content today.
Yeah, absolutely. Thank you, Gerry, for having me on today. So, as you mentioned, I'm a senior manager at Baker Tilly GWD LLP in Guelph and Elora, Ontario. I'm a cross-border tax accountant by trade, specializing in both Canadian and U.S. tax matters. I deal with a variety of industries when it comes to this geographical area, for anything from incorporated professionals such as your veterinarians, your doctors and dentists, to manufacturing companies, to construction and contractors, as well as on the personal side, when it comes to the cross-border tax, I deal with Canadian residents that happen to have connections to the U.S., and that's one of the main reasons for our discussion today. I could lead us into the essential topic for those Canadian individual shareholders that effectively own a stake in a Canadian corporation, if you'd like.
Yeah, and in 1 second here. So this is the most important thing, is that there is a treaty between Canada and the United States to protect individuals. But this is why we have Alessandro on the podcast today, because the treaty does not protect corporations. So today is really for that. We're going to go to some great detail on getting you familiar with Baker Tilly, and of course Alessandro as well. So yes, jump into it.
Great, thank you very much. So where I'll start is I'll break down the potential U.S. tax implications, specifically around Canadian individual shareholders who have a stake in a Canadian corporation, and they also have connections to the U.S. So these potential implications we'll specifically talk about are about controlled for foreign corporations, or CFCs, a filing called a 5471 and the requirements surrounding that, and other related issues. So effectively, if you're a Canadian shareholder who spends time in the U.S. or holds U.S. citizenship or a green card, I would say that this discussion is for you. So jumping right into a controlled foreign corporation, a CFC, these rules are an essential part of U.S. tax law that are basically designed to prevent U.S. taxpayers from deferring tax on certain types of non-U.S. income. Okay, so a foreign corporation is considered a CFC if U.S. shareholders collectively own more than 50% of the corporation's total voting power or value. That's directly, indirectly, or constructively. Okay. And for those that are listening, a U.S. shareholder is defined as any U.S. person who owns at least 10% or more of the CFC stock. Okay. Again, either directly, indirectly, or constructively. So I'll give a practical example in a second, because I'm throwing a lot of terms at you. So for Canadian shareholders specifically, the CFC rules will apply if you're considered a U.S. person to start. That's the first litmus test. Okay. So are you a U.S. citizen or a green card holder? Or do you meet the substantial presence test, and as such are treated as a U.S. tax resident? Okay. So now let's say you meet these definitions. You meet the definition of a U.S. shareholder, and the Canadian corporation that you have shares in meets this CFC definition. The IRS may require you as that shareholder to report certain types of passive income or global intangible low taxed income on your tax return, even if you haven't actually received the distribution. So in our world, and you probably know this term or have heard of this term, this can result in phantom income tax, where you're basically taxed on income you haven't actually received. Okay, so jumping into a practical example, let's imagine Sarah. She's a dual Canada-U.S. citizen, and she has a 20% interest of a Canadian resident corporation. Sarah has 2 siblings who are also U.S. citizens, and they each own another 20%, while the remaining 40% of the company is owned by non-U.S. individuals. Let's say they could be Canadians, let's say. So since U.S. persons collectively own 60% of the company, that being Sarah with her 20 and her 2 siblings with the other 40, it would qualify as a CFC. So then under those CFC rules, Sarah may be required to report her pro rata share of that company's passive income on her U.S. tax return, even if she hasn't received a distribution out of it. Okay, so the key point I would say is collective ownership. If there's a group of U.S. shareholders that collectively crosses that 50% threshold, that corporation can become a CFC, even if individual shareholders own less than 50%.
Okay. Now, a quick question for you. You mentioned that it's green card holders, it's U.S. citizens, and it can also be Canadians that have an E2 visa.
An E2 visa?
Yes.
Right.
Okay.
Where they're, sorry, the E2 visa is...
It's the investment visa. It's the
right.
investment visa and Canadian. So that E2 visa doesn't lead to citizenship. But that's how a lot of Canadians right now are moving into the States, is with those investment visas.
Right. So you had a question about that? I'm sorry.
Yeah, I'm just confirming that E2 it does include the E2 visa holder when it comes to these today's topic.
Yeah, that sounds like it makes sense. I personally don't run into many E2 visa holders. In my experience, it's generally,
Okay. The other thing I have, as we go into this, do you find that when these Canadians, or when the company's incorporated the first year, do you find that some of these guys, the tax reporting is not kept up right away because it's such a new set of rules and new country? And do you see that quite often?
Yeah, well, for where I am geographically, it's often enough. It happens more than you'd guess, being closer to Toronto, Ontario. Effectively, it's more or less during client discovery. A new client will come and they'll say, "Hey, I've got a manufacturing company here. I got an investment holding company there," and through the discovery process, you find out, "Oh, you're a U.S. citizen." Well, you've just walked yourself into more discussions about being about exposure to U.S. filing implications, right? Or establishing substantial presence, let's say, could walk them inadvertently into these filing obligations. So I would say it is happening more and more, especially as people are trending to establish stronger connections in the States.
And I guess that's where, and you are seeing more and more Canadians trying to expand their markets, going into the United States. And what do I need to do? And is that the initial step that they go through? Is that they have this idea and then they go to Baker Tilly and they say, "Listen, I want to move into the States," and then you basically, through the discovery, you just run with it.
That's right. Yes. So if in the example you're giving, if Bob approaches me saying, and Bob has a couple Canadian resident companies and he is applying for green card status down in the States because he's had enough with the snow and wants to go down to Texas or what have you, and he wants to establish green card status, these discussions have to be had, because Bob will walk himself into the CFC rules and ultimately filing a 5471, which is very complex and costly.
Now, is it possible that Bob we're all going to get to know Bob very well here. So
Okay.
Bob is now this Canadian person.
Yes.
He's established his U.S. business with the help of Baker Tilly in the States. Now, does Bob have any filing? Like you say, there is filing requirements for him corporately, but what about personally if he's spending less than 180 days in the States or whatever the case is?
Yeah, that's so just so I understand the facts that you're presenting correctly. Bob has a U.S. resident corporation.
Yeah, he's established a U.S. resident corporation.
Okay. And Bob has stronger ties to Canada right now. So he's a Canadian resident.
Correct. And he doesn't
Right.
have the green card. He doesn't have U.S. citizenship. What kind of exposure would he have individually?
Individually, Bob would have to worry about any sort of U.S. source income that's distributed out of his company. So, for example, if there's dividends paid out, he takes a salary from that U.S. company. And for a salary, for example, depending on the state that U.S. company is situated in, there could be state withholdings, then there's federal and Social Security withholdings that would walk you into a filing requirement. When it comes to U.S. dividends, if he were to receive that as a non-resident receiving that, he, depending on additional facts and circumstances, he might just get away with withholding tax on that dividend that's paid out to him. But so that could be a separate scenario. So depending on the type of income that he receives from that U.S. company, he could have a filing requirement. Yes.
Okay. And how big is the like in Guelph with Baker Tilly right now? How big is your team when it comes to the amount of volume you guys are doing and team members, et cetera?
Yeah. So we're in two offices, Elora and Guelph. Elora is the mothership, for lack of a better term.
Okay.
But Guelph is growing and growing very quickly. So right now we're about 75 people strong. So we're a medium-sized firm. When it comes to our U.S. tax department, we're actually quite niche, and it doesn't require a lot of human capital at this point. But we still provide excellent service to our clients.
Okay. And it has become popular. So now you've been with Baker Tilly for how many years now?
Going on my third. Yeah.
Okay.
Or sorry, third going on my fourth.
Okay. So in the last 3 to 4 years, the volume on the U.S. corporate side has been increasing by a lot, I would imagine.
Yeah. The cold calls especially have been increasing for sure. So there's been a lot of one-off consults and stuff like that where we'll have an interested party ask some initial questions, and if it's a right fit for the firm, then we'll continue on with that discovery process. But if not, in Baker Tilly, we're an international cooperative, so if they'd be better suited with a New York-based firm that has a Baker Tilly, we would happily refer them there. Versus if they have Canadian filing obligations and other Canadian connections that we could handle as well, all in-house, then that would be an easier decision for them to work with us as opposed to another Baker Tilly cooperative.
So you must come across a lot of clients that these business owners, they expand into the States. Maybe they used a smaller firm that didn't have the rural expertise. Now they got themselves in a bit of a filing problem. You must look after must be doing a lot of damage control and fixing things as well too.
Yeah. We've definitely had our fair share of getting, on the individual side, getting folks caught up that just never knew, for example, that they had a U.S. filing obligation individually. I'm sure you're familiar with the streamlined filing procedures, offshore method, and stuff like that. We have tons of experience helping folks get compliant that way. Same with U.S. estate tax. We find out actually very recently, a referral came through where there was a individual that passed away a few years ago. They owned a 1/3 life interest in a California property. The family had no idea that there was any sort of exposure for U.S. estate tax purposes, and we're now working on that as well. And then also from the corporate side, we've helped either file treaty-based returns to cover off and protect these companies that may have some exposure to U.S. corporate tax, as well as just getting caught up on delinquent filings. So with the U.S. tax system, I'm sure you can appreciate it's as complicated or more so than the Canadian one. So, and especially when you're in this country, it's not actively advertised like on CBC or Sportsnet.
Yeah, and I guess the other thing, I think the other thing that really scares people is the fees. Not so much the fees, but the penalties. If someone
That's
is,
right.
people get intimidated, and then all of a sudden it comes time that they're getting letters from the IRS that you haven't filed. Let's talk about some of the penalties that really do scare people.
Yeah. The penalties are very different than what the Canadian regime has when it comes for non-compliance. So, circling back to the CFC example, for failing to file a 5471, failing to file it or filing it incorrectly has penalties that start at $10,000 US per form per year. Okay, so it's very crucial to comply with those types of with those filing requirements. And also, I would add this penalty applies even when no tax is owing. It's a simple disclosure form that the IRS wants to know about, and if you miss it, then you're walking yourself into some significant penalties that can accumulate quickly. Now, that's not to say that that's the be all end all, because there are programs. There's the first time abatement that taxpayers can apply for, which we have successfully done before, where if the client has a positive compliance history with the IRS, and just for a reason that was out of their control, let's say they weren't able to file on time, there was a death in the family or something that would really got in the way of them normally filing on time, then you can successfully get those penalties abated. And these $10,000 penalties apply to the 5471, the FBAR reporting, which is a disclosure of your foreign financial accounts, as well as if you have an interest in a foreign trust, the 3520 forms. Those penalties can accumulate at $10,000 increments as well. So it is very scary, and you don't want to receive those letters, because with the IRS, the wheels turn very slowly there. So even if you've received the letter, you've engaged a CPA to help you out and start the process back and forth with the IRS, you may receive another letter a month or two later applying another penalty to you, even though you're actively getting to work on it and starting the conversation, because these tend to be, depending on the department, automated. I know it's gotten better recently, but these are some of the scary stories in my experience that I've run into.
Well, I have to tell people the big takeaway today is that just having an accountant there like Alessandro to help you with these, you got yourself in a bind. You need that help of a professional to make sure that these, like you say, these penalties can be, in some cases, can be reversed, and you can't get these things done on your own. And I've always said that about our podcast. This is not a do-it-yourself podcast. We don't want you to take this information and go home and try and figure it out. We want you to be able to connect with people and our partners like Alessandro to pick up the phone, give them a call, and assist with them. Because my experience dealing with both on the Canadian side with CRA and with the IRS, it is intimidating. And we even went through that process as well. We incorporated a couple of businesses. We got the E2 visa. And as much as I know about Canadian-U.S. tax, I still don't know the filing requirements. And one of the partners that helped us with this, I couldn't have done it without them. So we appreciate it. But anything else so let's just do it right from the very beginning. When you have an idea that you want to go into the States, let's go through that process. And like you say, it's a discovery first. So I'll let you take over, and then we'll wrap things up and we'll get you back to work, because I know you're pretty busy today.
That's right. Okay. So let's say Bob approaches me and says, Alessandro, I've made the decision and it's final that I would like to move to Texas. I say, okay, great, Bob. But first, there's Canadian tax implications you have to worry about and also U.S. tax implications. So on your way out, you're going to have to worry about your departure from Canada. So there's potential departure tax implications when it comes to some of the assets that have unrealized gains that you have in your possession. Those are your non-registered accounts, certain shares in corporations. It's personal property, even stuff like that is all subject to a deemed disposition where you're taxed on your way out, but that would be your final tax liability to Canada on your way out. And then on your way into the States, you have to establish your residence in the United States. So you're going to have a dual status year return when you enter the United States, establishing your residence there. And from that point forward, you would be reporting your worldwide income in the States. Now, Bob, if you want to maintain your shareholdings in your manufacturing company and your holding company, that's going to come with some additional compliance and a lot more discussions with your accountant, yours truly. That would be by walking through the Form 5471 and make sure that's filed on time in conjunction with your U.S. tax return, as well as ensuring that all of your records are very detailed and kept up to date, including your ownership percentage in that Canadian corporation, any dividends you receive from that Canadian corporation, or other financial information that may or may not be important. So those are a cursory amount of advice that I would want to cover with Bob right away as soon as he let me know that he was thinking about moving to the States.
Well, I got to tell you, this stuff is so confusing. And like I say, even with us being involved with it and going through the process, I could not imagine doing this without a U.S. accountant. So, Alessandro, I'm sure we'll have lots of chances to talk and work with mutual clients going forward. But one last question. Is the Republican government going to make it easier or harder for you with your job? Is there a consensus out there?
In the circles that, in my circles, there's optimism. So based on what I understand, yes, there was some recent news I'm sure you can probably think of when it comes to imports and exports, tariffs and whatnot, that's giving people a cause for concern. But there's also a push, or from what I understand, to decrease complexity in the U.S. tax code. So that, along with not letting the U.S. estate tax exemption sunset, which was, I think, scheduled for 2026, from its 13 million mark down to around 7, I believe. I think that's going to get extended because the Tax Cuts and Jobs Act is the reason why that exemption was jacked up to that high amount. So those 2 points point to optimism in my circles, and I'm thinking that, and I subscribe to that line of thinking. I don't think that the administration wants to make things more difficult for their taxpayers. I think they want to reduce complexity, and by reducing complexity, they could inadvertently increase compliance, if you think about it that way. So.
Yeah. Well, tell you what, I really appreciate your time today. So thank you very much. And we look forward to seeing you in person one of these days. We're going to be doing the world tour here from British Columbia and making our way across.
Great.
But thank you kindly, and we'll let you get back to your day.
Yes, thank you so much, Gerry, and have a great day.
Thank you again for listening to the Snowbird Expat Radio Podcast. The best way you can support the podcast is to forward the episode to a friend, and please don't hesitate to like, subscribe, or leave a comment. Now, before you go, let me leave you with one of my favorite quotes. Be kind to all, the world is small.